Hi there, my name is Stacey Bartel and I'd like to welcome you back to O.B.S Financial Services educational series, Learn from the Tax Master. Today's Wednesday, February 27th, and I'm going to start off with asking you a question. Have you ever compared your T4, which you should have gotten in the mail in the last couple of days, or you'll be getting it over the next couple of days? Have you ever looked over your T4 and compared it to your pay stub from last year? More specifically, have you looked at the amount of income your employer says that you got paid on your pay stub and compared it to your T4? If you have, did you find a difference? Well, if you found a difference, you've likely received taxable benefits, and that's why the amounts are not there. Just to clarify something, this is what most people don't know. Under the Income Tax Act, the amount of money that you get paid throughout the year is payable based off of your paycheck. So if you get paid on the 27th of December and you still work till the 31st, the income that you make from the 27th to the 31st, because you don't get paid for it until the following tax year, doesn't appear on your T4 for this year. It appears on your next year's tax form or T4. So that leaves some of the difference being taxable benefits. Well, what are taxable benefits? Taxable benefits are items that you receive from your employer in lieu of pay. So when we talk about that, basically if your employer pays for things on your behalf, or if they give you something and they're doing that instead of giving you additional pay, you have to pay tax on the value of that. Probably the most common example of a taxable benefit is if you belong to a group benefits plan and your employer pays for all the benefits. Part of those benefits will be life insurance. If the employer pays for life insurance, they're not allowed to, so therefore it's treated as a taxable benefit, and you have to pay tax on the amount of money that they pay for you. So how does that work? Well, let's take a look at, let's say your life insurance premiums are $15 a month. Throughout the year, that would end up being $180. Since you don't have the $180 deducted from your pay, your employer pays for it on your behalf, they have to add that to your income. So when you look at your T4 at the end of the year and you look at your pay stub, you'll see, okay, your pay stub said that you made $50,000, but your T4 says you made $50,180. If you look at the bottom of your T4 in box 40, one of the ones at the very bottom, there should be a box 40 amount that says $180. That would be the value of the life insurance. It gets added to box 14, which is what you have to pay tax on, and you will have to pay tax on that $180. What does it actually cost you? Well, it's not a full $180 as if it was deducted. You only pay based off of your tax bracket. So if you're a middle income earner, you make somewhere between $47,000 and $68,000 a year in Manitoba, you're taxed at 33.25%. At 33.25%, that $180 would end up costing you $59.85 in tax. So, does it make sense? All right, well, I'm going to assume it makes sense, and we're going to continue on. So, I've talked a lot about group benefits over the last week or so, and I'm going to try and move my conversations from there, but they do make up an important part of understanding a lot of things with your payroll when you have a benefit plan. But other common benefits are gifts, achievement recognitions, or awards that exceed $500. So what we're talking about there is some employers will give you gifts at Christmas time instead of a cash bonus, right? If you work for a company on your milestones, 5 years, 10 years, 15 years, 20 years, 25 years, they may give you a gift. That goes back to the proverbial gold watch ceremony upon retirement. Well, if they give you a gold watch that's worth $499, it's 100% tax-free to you. Great, thank you very much. But if those gifts exceed $500, they become a taxable benefit, and the employer has to add the value of that gift to your income, and you have to pay tax on it. We talked a little bit last week about subsidized parking. If you work in an area where you would normally have to pay for parking, even if it's the employer's parking spot, if there's a market value for the use of those parking spots, you may have to pay a taxable benefit. So if you're parking, let's say that you're getting subsidized. So if the Impark owns a parking lot across the street from your work says, okay, well, we want to make it easy for you. We're going to, it's $200 a month. We're going to pay $100 and we're going to charge you $100. So they would pay the entire $200 to Impark. You would end up having $100 deducted off of your paycheck. That would be a payroll deduction. The other $100 that the employer is paying would be a taxable benefit, and you would have to pay tax on that. All right. Other ones, tips. In the service industry, normally tips are required to be reported by the employees, and the employers don't keep track of it. However, in some service industries, especially where, tip parties, when you're dealing with a group of 8 or more, and the gratuity of 15% is automatically added to the bill, in those cases, the gratuities may end up as part of box 40 on your T4 as a taxable benefit. They wouldn't have taxed you on it, but you do have to include that in your income. Boarding, lodging, free rent, or below market valued rent. Be nice to have free rent for all of us, but that doesn't normally happen. Where we find the areas where you get boarding, lodging, free rent, or subsidized rent is, number one, if you're working remotely. So you work up in a work camp in up northern Alberta, and they put you into a camp. Well, the value of the food in the camp every day is a taxable benefit to you in some cases. Other cases are, and this is probably more common, my employer transfers me from Winnipeg to Saskatoon. While I'm in Saskatoon, I'm looking for a house. I have 2 or 3 months. Part of the conditions I make with my employers, you guys need to pay my accommodations until I find a place. Anything over, a week to 2 weeks would end up becoming a taxable benefit. The employer would add that to the value of your pay, and you would have to pay tax on what they paid for rent in that period of time. The reason why I use 2 weeks is typically you get 2 weeks when you move for temporary accommodations. So the first 2 weeks, even if it's on your T4, you get to write the value of the first 2 weeks off as a moving expense if it's included as a taxable benefit. Anything after that 2 weeks, you're not able to write off as a moving expense, and that's a different part of the act. Rent-free or below market value rent is typically looking at caretakers, apartment building managers, hotel managers, resort lodge managers, people that have to go up at, if they're working at a resort remotely, or if you're taking a look at a 100-suite apartment building, you may receive your rent for free. Well, that free rent ends up being taxable to you as far as a tax deduction. Same thing with members of the clergy. If you're living in your church or accommodations supplied by your church, that amount may be taxable for you. Now, there's other offsetting deductions again, but it's all needs to be reported on the T4. Other ones are personal travel, trips, vacation rewards. So if you're in the sales industry, or if they have certain customer service incentives that you exceed this, they're going to give you a free trip to Vegas for the weekend, or they're going to send you to Mexico for a week. Though the value of that trip for you and or your wife or husband would end up being taxable. If you're looking at, even if you go to a convention, let's say you're going to a convention and the convention is in Hawaii, and you want to stay for the weekend afterwards to go and check it out. The accommodations for you, the value of the hotel room during the convention, the night before you check in, and the day that you check up to the day you check out, would be a work-related expense and not a taxable benefit. But if the employer paid for the extra 3 days on the hotel, or if they upgraded you to first class on your planes, or whatever the case is, the value that they give you, or if they even let you keep your rental car for an extra 3 or 4 days, that would all have to be calculated in as a taxable benefit. Same thing with education. If your if you're going to school, your employer may be paying for the trip. Well, if it's not work related, or paying for your school, if it's not work related, and it's just for general interest, but your employer says they'll pay for it, that would become a taxable benefit. Other times they'll charge you a taxable benefit to go to the school, but then you're able to deduct the value of the tuition and educational amounts, which now are only provincial, but that would be there. Basically, if you can understand this, the term that comes to mind is there's no such thing as a free lunch. The government wants a piece of everything that you get. Now, In addition to some of that, sorry, I had to get something off my screen there. In addition to some of that, other people that have conditions of employment that may be required to spend money out of pocket on their own behalf and or get reimbursed from the company, or the company pays for things on their behalf, you have to be careful, because sometimes the employers will sneak that in. Well, not sneak it in, but sometimes they'll place that in and they'll put it in on your box 40 as a taxable benefit. So, for example, I have one client that does a lot of travel. He books all of his own he has a corporate card, so he pays for all of his airfare. He puts all of his gas on his corporate card. He puts all of his vehicle expenses on his corporate card. He puts his auto pack on his corporate card, all the rest of it. And the company just pays off the corporate card, right? At the end of the year, his box 40 is, in excess of $20,000. That's the value that the company paid for everything there. Now, what that means is that client of mine, that employee, because 100% of those expenses may be deductible, has to include all of that on top of his income, and then he gets to deduct the employment expenses to offset that. So, things like the flights would be 100% deductible. Things like gas and vehicle repairs and auto pack and everything else would be deductible on a prorated basis based off his vehicle use. Again, this is a lot of information we'll talk about when we talk about employment expenses, what's deductible, what's not, and how you need to track it and audit proofing yourself, but that's probably a couple of weeks down the road. Anyways, I just kind of wanted to touch base on those. I guess the last thing I'd have to say on this is just remember your payroll, the employees that work in your human resource department and your payroll department may understand how to enter in hours, how to change your rates of pay and everything else, but they're not necessarily tax professionals. They may be coding things in as taxable benefits that are not supposed to be there, or they may not be separating things out properly and telling you what you can or cannot deduct. So what I suggest to all of our clients is take a look at your box 40 on your T4. If you have, especially if it's a large amount, when I say a large amount, in excess of a couple of $100, chances are there's something in there that may be deductible for you. And you have every right to go to your payroll department and ask them for a detailed printout so that you understand what you are receiving that's a taxable benefit and what is not. Share that with your tax professional. Your tax professional should be able to tell you whether it is a taxable benefit or not, and if you can deduct anything because of it. Anyways, that kind of touches base on taxable benefits. I hope everybody understands it. Tomorrow being T4 day, yay, it's time to start doing our taxes. Join us tomorrow when we're going to take a look at your T4. We're going to discuss some of the boxes on the bottom that you may or may not understand, and explain them to you so that this way you have a good idea as to what's deductible off of that, what's not deductible, and how it affects other things. Once again, thanks for tuning in, and I look forward to seeing you tomorrow. Have a great day.